Investors are holding their breath ahead of the annual Jackson Hole Symposium on Friday. Reminiscent of the forum held in 2010, investors are full of hopes that Chairman Ben Bernanke will give some hints on the outlook of the Fed's quantitative easing policies. Not wanting to pour cold water over this hope, but we do not expect much surprise to come from the symposium, mainly due to the fact that the many thoughts of policymakers have already been disclosed in the minutes of the August Federal Open Market Committee meeting. We expect the rundown of Bernanke's speech will be similar to those made in past years, including discussion of the economic outlook and the Fed's policy responses. He will probably also elaborate more on the various options for easing tools, with pros and cons of each one being addressed. In 2010, Fed Chairman Ben Bernanke talked about various easing measures and hinted about QE2 at the Jackson Hole Symposium. Therefore, as the global economic outlook continued to deteriorate and the U.S. job market remains sluggish, the market awaits to get some indications for the Fed's future actions, especially the likelihood and timing of QE3 at the event to be held this Friday. In our opinion, Bernanke's speech will contain little hints on QE3 as the Fed is not yet ready to provide further unconventional measures. This can be seen from recent debates among Fed presidents. Indeed, the U.S. economic data received since the August Federal Open Market Committee meeting was largely mixed, and improved financial conditions have given the Fed more time to think about the case more thoroughly. Meanwhile, the imminence of the European Central Bank's reactivation of bond purchases has also reduced the urgency of any immediate easing. We expect Bernanke will evaluate the pros and cons of various easing tools discussed by the Fed, although many of them have already been mentioned in the August Federal Open Market Committee minutes. For instance, concerning QE3, many members believe that such a program could provide additional support for the economic recovery, both by putting downward pressure on longer-term interest rates and by contributing to easier financial conditions more broadly. In addition, some participants noted that a new program might boost business and consumer confidence. On the flip side, there are concerns about the effects of additional asset purchases on trading conditions in markets related to Treasury securities and agency MBS, but others agreed with the staff's analysis showing substantial capacity for additional purchases without disrupting market functioning. Moreover, several worried that additional purchases might alter the process of normalizing the Federal Reserve's balance sheet when the time came to begin removing accommodation. A few participants were concerned that an extended period of accommodation or an additional large-scale asset purchase program could increase the risks to financial stability or lead to a rise in longer-term inflation expectations. Other tools he might talk about include flexible asset purchases, cutting interest on reserve, forward guidance extension and the Bank of England type funding for lending. While we expect no surprise from the Jackson Hole Forum, we retain the view after the August minutes that the Fed would announce additional monetary measures in September. What we expect to hear is a change in language, indicating that exceptionally low interest rates will be warranted until 2015.